Hi, everyone. This is Jason Murak of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest and one of my favorite guests. He is editor and publisher of one of the top investment newsletters on Wall Street for many decades, Dr. Marc Faber. Thank you for joining me again.
It's a pleasure. Thank you very much for having me. And good day to your listeners and viewers.
And Marc is editor and publisher of the Gloom, Boom, and Doom Report. Today, we're recording the interview on Tuesday, April 8th, 2025. Marc, just an absolute crazy day in the markets today, and seems like almost every day for weeks now. We have the S&P 500 is down below 5,000. The VIX hit 55 today. I think overnight a couple days ago it was at 60. It's been just absolutely wild swings. A huge swing in the 10-year U.S. Treasury bond market yield. I think it got as low as 4.15 a couple days ago, and today I think it hit 4.26. But before we talk about some of those things with maybe the plan that Trump and his U.S. Treasury Secretary have for maybe refinancing the debt, I want to get your thoughts on free trade, tariffs, neo-mercantilism, because I know you've studied financial history. Would you call the current global financial system we have now with global trade, would you call that a free trade system?
I don't think the world has ever had an entirely free trade system because there are always some restrictions on trade. But I'd like to point out that over the last, say, 40 years, trade as a percent of global GDP has been increasing until recently, maybe, say, 5-6 years ago. And since then, it hasn't been expanding. But during the period of trade expanding as a percent of global GDP, usually the world experienced a period of prosperity. And usually protectionism is very negative for the prosperity of the world. Now, under protectionism, some people thrive? Yes, because it protects them, but it's negative for the entire economy. So this is basically my view. But I'm aware, when I wrote my thesis, I was at the time 23 years old. I went to England and I wrote about the financial reform of Robert Peel, which was mostly a fiscal reform because England at the time had very protectionist economic policies. They had the Navigation Act and the Corn Laws that were restricting imports into the United Kingdom. But after Robert Peel, after his reform of 1842, England went into free trade and it abolished the Navigation Acts that were highly protective tariffs, essentially, on shipping. And they also abolished the Corn Laws, and the world then thrived. But I'm aware at the time there were very heated debate in Parliament, and some protectionists had valid arguments. But in general, my view, you asked me my view, I think that free trade is the best medicine for global prosperity.
Yeah, I agree. I think the more trade, the better. The problem is, I think, like the way the global financial system is set up, Marc, with the exorbitant privilege of the US dollar as a world's reserve currency. And then we get into Triffin's dilemma, where it seems like the US for many, many decades post World War II has basically just shipped dollars. They haven't actually produced a lot of stuff. They financialized the economy, turned into mostly what capital investment and investment in asset classes, and they actually haven't produced things. The US isn't actually doing a ton of trading. It just seems like the US is shipping out dollars for other countries' goods. Is that accurate, or do you think that's like inaccurate?
Well, economics is very complex. And this statement, I think, is by and large correct. But equally, if someone comes to me and says, look, that's not true, and so forth, you have to consider this and that. As you know, Trump says the world has been ripping off the US. That, I can say, is a complete wrong statement. The world has not been ripping off the US. If anything, it's the US that has been ripping off other countries. And you have to consider, it is true that China produces goods at lower wages than the US. But for the US, this is actually an advantage to have countries produce goods at a lower cost and import them into the US. The US consumer benefits from that. The one who doesn't benefit is the one who has the low wages. But there are other aspects about this. The US workers who had excessive salaries to start with. Now, someone will say, well, that's a wrong statement, excessive salaries, because the price level in the US became excessive because the dollar was fixed to other currencies. So in 71, Nixon went off the gold standard and devalued the dollar. But the wages then still were high relative to the rest of the world. So my view is that the tariffs are a tax. The tax is not sure that it will fall on the people that make the goods in China and Vietnam and Bangladesh. The tax will be paid mostly by American workers who buy goods from these countries. I mean, say someone buys a Nike shoe. The Nike shoe is not made in America, it's made somewhere else. He will pay a tax. That is for sure.
Yeah, I agree. The tariffs, I think a lot of people don't understand that tariffs are actually taxes. So the US government was initially, when it was way smaller, it was just funded with smaller amounts of tariffs, and then there was fights over that. But we're at this point where the government, DC budget deficits are so large they can't be funded just with a few tariffs anymore.
Correct.
But I 100% agree with you on American workers, also American small business owners, because if you're a small business, it's going to be tough sourcing and all these higher cost inputs. You're not going to be able to necessarily pass them on to your customer. It's going to hurt small business. It's going to hurt the average middle class consumer standard of living. It's going to be more shrinkflation. They're not going to have as much purchasing power with the economic term. They're not going to have as much purchasing power with these tariffs.
I suppose that's correct. But I want to point out, my view is that the stock market is going down for other reasons than the tariffs. The stock market peaked out somewhere between November and February of this year, because not every stock peaks out exactly the same way. So the Magnificent Seven, they actually peaked out this February. And then they started to go down. The reason they started to go down is largely because they were grossly overvalued. The stock market, the analysts, of course, they always look for reasons why this happens. But the fact is, the easiest is to look at stocks as going from undervalued to overvalued, and from overvalued to again undervalued. In other words, investors are continuously committing the error of optimism and the error of pessimism. And we committed the error of optimism in the period 2024, and we had committed the error of optimism already in 2021 with the SPACs, with the meme stocks. All these stocks like ARC Innovation, they peaked out in 2021. They didn't make a new high in 22. So different groups within the asset inflation peak out at different times. And foreign stock market, they had peaked out years ago, and they underperformed the US grossly. The US last year became grossly overvalued relative to emerging markets and relative to Europe. Grossly overvalued.
It also looks like profit margins may have peaked too, Mark, because as you were talking about with what Trump is trying to accomplish here with a combination of tariffs and subsidies, neo-mercantilism, protectionism, trade wars, it looks like the profit margins for a lot of these companies is going to peak. They're looking at higher labor costs or input costs unless they transition a factory over to robots. They're looking at other higher input costs. The customers may not want to pay a higher tariff. That may reduce demand. So these things, do you think the market is weighing these things and saying that profit margins and earnings growth may have peaked then?
Let me explain what I think has happened. I think that after 1980, 81, 82, we had an asset inflation in the world and in particular in America, which led to higher consumption than would have occurred had we not have had the asset inflation. Asset inflation is when, say, stocks go up, properties go up, collectibles go up, bitcoins go up, certain commodities go up. When this happens, people feel wealthier, and you can observe, say, if you go to a restaurant after a week of rising stock prices, there are more people in the restaurant than if the market has been down for a week. That I assure you. So we had this overconsumption in the US, a symptom of which is the trade deficit. The trade deficit doesn't occur because China necessarily produces goods cheaper than the US. It occurs because the US consumes too much and produces not enough.
Well, isn't that also a symptom of the world's reserve currency? And then we get into what Triffin was predicting would eventually happen, in the late 1950s, early 1960s. He predicted that eventually the US would massively abuse or misuse the world's reserve currency with these budget deficits and trade deficits. They would run twin deficits, as Luke Roman has said, way too large, and then we'd get to a tipping type of point.
Yes, I think the peak US dollar is behind us. I think the dollar is grossly overvalued. And the Treasury Department in the US and the Fed, they know that asset price declines in America would be very painful for the economy. And they may choose inflation over rational thinking, you understand? In America, the Fed and also the Treasury, they can boost, the Treasury can boost its spending, and the Fed can keep on buying and monetizing debts. And when that happens, the dollar will go because foreigners will no longer trust the US dollar. And a symptom of this having occurred already is actually the increase in the price of precious metals. And I think the dollar is highly vulnerable here.
Okay, so for listeners out there, Mark is talking about that the central bank, the Federal Reserve Bank, may intentionally devalue the dollar because they don't want a strong dollar, and that would produce, you're saying, another nominal rally in the stock market. So that wouldn't be based on any fundamentals, free cash flow growth, earnings growth, anything like that. That would be more similar to what's happened in Argentina, Zimbabwe, and Venezuela with their stock markets when they debase their currency. Okay, so I was just summarizing for the listeners what you were talking about, how the Federal Reserve Bank and the Treasury, Trump may try to force them to debase the currency, monetize debt, to devalue the dollar, so that juices the asset prices. But that wouldn't be based on any fundamentals like earnings growth or free cash flow for the stock market going up. That would be based on devalued currency then, similar to what happened in the past with stock markets in Argentina, Venezuela, and Zimbabwe.
Yes, that is correct. And basically, through devaluations, you're not going to create wealth. You understand? Maybe the stock market goes up in nominal terms, but it declines in the real terms. In other words, if you measure the Dow Jones against gold, in that situation, usually gold will perform better than the stock market in nominal terms.
Now, in the past, Mark, when the stock market tops and heads into a bear market, it sounds like you're predicting at least like a short-term bear market for stocks until maybe the Fed reverses its balance sheet reduction policy, quantitative tightening, and goes into some type of quantitative easing or balance sheet expansion. Isn't that normally good for the U.S. Treasury bond market, or do you think that we're not going to see a rally in in the bond market?
This is an excellent question. And I have to clarify one point. I think the asset inflation that we had over the last 40 or so years is coming to an end, and that from here on, the returns from stocks will be very disappointing, or like in the 70s, between 1966 and 82, stocks in America moved sort of sideways. But in real terms, inflation adjusted, they were down 70%. I think the same could happen. I think you're not going to make money out of assets in the next few years. That would be my view. And it's not a short-term bear market. I think it's a long-term bear market that will last at least 2 years or 3 years. But the second question is, the unusual thing about the last few days is that traditionally, when you had bad days like the last 3 days, Treasury bonds rallied, but they haven't rallied this time around at all. That must be worrying the Treasury, but because the Treasury wants to refinance the debt, and at this, in the current situation, they're actually going to pay more for the debt than they paid already.
Did something similar happen in 66 to 82? Wasn't there also a U.S. Treasury bond bear market because there was a lot of inflation, stagflation until Paul Volcker came in and started raising rates faster than Arthur Burns did? But wasn't there a long-term U.S. Treasury bond bear market then? Because weren't the treasuries, correct me if I'm wrong, called like certificates of confiscation? Do you see similar types of things playing out now?
Well, that is again a good question, because inflation and interest rates and commodity prices move in long-term cycles. So if we take a peak in, let's say, commodity prices peaked out in 1921 in the US. And then they had a sort of declining trend. And we bottomed out for interest rates and commodities in the 1940s during World War II. And after World War II, 1942-46, interest rates had a rising tendency. In other words, until 1981. So roughly 40 years of rising interest rates. After Volcker, interest rates and commodity prices came down again. And I think for interest rates, we reached a major low in May, August 2020. The 10 years Treasury reached an artificial low of 0.57%. And after 2020, the Fed, of course, didn't notice it. Because at that time, we had the dumbest Fed chairman in history of the US, Janet Yellen. And after that, interest rates rose and inflation accelerated. And in my view, Trump is a character, an interventionist that will create inflation. And that the inflation rate already today is much higher than what the government is publishing. I want to stress much higher than what the government is publishing. I think people, they live in an inflationary environment of about 7 to 12% per annum, not the 2.8% the Bureau of Labor Statistics claims. It's a fraud to say that inflation is so low. Anyway, I believe that the economy could be so weak in the next 6 months to 1 year that Treasury yields do come down, and they can force it down by cutting short-term rates dramatically. That they can do. But long-term, in my view, the long-term bond market, I think the long-term inflation outlook is for prices to go up more than is generally speaking expected or expected by economists. And that's why the bond market, the Treasury bond market, is not rallying. Now, as I said, the economic statistics could be so bad in the next 6 months that bonds would rally somewhat. Or even if bonds don't rally, for the last 1 month, an investment in treasuries was better than in stocks. I can assure you.
Well, doesn't Trump and Besant, they've talked about this publicly on podcasts. I think they've been discussing this since before Trump actually had the inauguration, him and his new Treasury Secretary, because he was a global macro hedge fund manager for many years on Wall Street. They actually want to refinance, $9 trillion of debt in the next 12 months. They want to refinance that at as low rates as possible because Janet Yellen, didn't she do most of the Treasury debt refinancing at such short-term rates?
Look, there are two things in life: what you want and what is happening. The fact is simply that US Treasury yields at around now 4%, say plus minus 10 years, the notes are 4%. That interest is not very high, considering that some private economists think that inflation is running at 10% per annum.
So you're saying that the real inflation rate is far above anything in the bond yield. So the bond market, are you saying then that the bond market doesn't really care quite yet about inflation, or they would demand much higher yields?
The bond market, the long-term bond market, is concerned about inflation, and that's why it isn't rallying much. That's what I want to express. Can you understand that? Normally, yes. If the stock market goes down the way it went down in the last 2-3 days, bonds would rally, but not this time. So the question is why it doesn't rally. It doesn't rally because people are concerned about future inflation.
Yeah, we had a nice move up in yields in the 10-year US Treasury. That was a large spike, considering it was counterintuitive compared to what it would have normally happened, like you said, because if the stock market is starting to correct, I think there was an 8-point swing yesterday. Normally, those funds, the capital flows from a hedge fund manager or generalist money manager, that capital, would end up in US Treasuries, 10-year US Treasuries, probably.
Correct. But the important thing to understand is Trump is an interventionist, and he's also someone without any economic knowledge. He's an ignorant, and that is the problem. And Besant was a hedge fund manager. He knows the international scene probably a little better than Trump, but he's no god. That you have to realize. And his interest may be slightly different than the interest of the American public.
Well, also they inherited, this is a decades of accumulation of bad policies on top of each other. I mean, the base case, Mark, post 2008, it was $1 trillion budget deficit, whether it was Republican or Democrat. And then during the pandemic, 2020 onwards, it was even larger than $1 trillion budget deficit. So the base case was $1 trillion. Here we are now. Look at the size of the national debt.
Yes, nobody believes that they can reduce the deficit significantly.
Now, do you see a lot of similarities between the bad policies of the 1920s and 30s with like Smoot-Hawley tariffs and subsidies, Herbert Hoover, then FDR basically doubling down on similar policies to Herbert Hoover? So Republicans and Democrats using similar Keynesian and interventionist central planning policies. Do you see a lot of the same policy mistakes from the 1920s and 30s happening right now?
The problem with interventions is that one intervention then necessitates another intervention, and the interventions have a lot of unintended consequences. And my view would be that this administration is a collection of not particularly knowledgeable people that are, however, extreme interventionists, and that they will mess up the system, to put it politely, that they will mess up the system in an incredible way. That is my concern. And I think the stock market is going down, not because of the tariffs themselves. The tariffs themselves have some impact, but not that much. And let me explain you why. Nike sells a shoe here in the USA for $100 or $150. That shoe is made in Bangladesh or in China and is sold by the producer of the shoes in China for $10 to Nike or $12. The tariff is levied on the $12 or $10 at which Nike buys the shoe. But the sales price, as I said, is $100, $150. That doesn't get touched. And so the importer or the retailer, he can easily absorb a higher price. But he will, of course, try to increase the price. So there's a price increase that will happen. But basically, the impact is not as large as would appear when they say China will have to pay 100% more tariffs and so forth. The impact is not that significant.
Why do you think so many non-G7 central banks the last 3 years since the Russia sanctions in early 2022 have started to accumulate more gold than treasuries?
Well, I think the reason is very obvious. When you have the US arbitrarily seizing assets of foreign central banks, you would have to be a complete idiot to hold a large amount of your reserves in US dollars. So I think it's logical that foreign central banks increase the asset allocation in gold and silver and through sovereign wealth funds in other assets, then hold reserves at the central bank or at the Treasury in the US.
So you don't think that that trend is going to break basically as long as the DC spending keeps on this way and more bad policies from both political parties in the White House or Congress? You think then that that's just going to keep incentivizing the BRICS, the non-G7 central banks? Why are we buying treasuries? Why are we condoning this behavior? Why are we subsidizing these idiots in DC? They're just going to keep buying more gold then?
I think this is a trend because if you go back to the 60s, central banks held maybe 70% of their reserves in gold. And now it's down to maybe, 10% or even less. And so the trend has now started among central banks to increase the portion that they hold in gold. And I think they're not going to go back to 70%, but they could go back to 20%. And then a phenomenon that I need to explain is if you go around the world and you attend cocktail parties, women and men to lesser extent will say, oh, we own gold because the price of gold has gone up. But when you dig and you ask them, well, how much do you own? or to say, oh, I inherited a few coins from my grandmother or grandfather. But the very few people that hold, say, 10, 20% of their money in gold, that I want to point out. The billionaires, there's thousands of billionaires in the world. Go to them and ask them, how much precisely do you own in gold? It would be a very unusual thing that you find a billionaire who has more than 10, $20 million in gold. It's very seldom that you find one with 100 million in gold or 200 million. So I think a lot of wealthy people, they will look at the financial system. I mean, it doesn't take a genius to see that there's something wrong with the financial system, with the leverage in the world, that this will lead to a crisis at some point. And these wealthy people will one day say, well, maybe it's a good idea that I put 10% of my money in gold, physical, not in gold shares and not in options, but physical gold in storage. So that, I think, will boost the demand for precious metals.
Yeah, over the last couple of years, you've seen a big spike up in monthly average purchases, dollar cost averaging. I call it for non-G7 central banks. That they went I think it was 1,000 tons in 2024. That was like a 40% of the annual mine supply central banks bought. And then there was a huge increase in Asian retail investor demand. I think the new demand increase, Mark, is going to be these institutional investors, so pension fund money that didn't even have 1% asset under management exposure to gold or gold stocks. And I think now that the gold price has stayed relatively high for a while, I think you're going to start to see that 1 or 2% allocation for those generalist money managers, those tens of billions or hundreds of billions of dollars.
I agree.
Yeah, so I think like that's from my gold industry contacts, people at the World Gold Council, people who run gold companies. They're telling me they're getting phone calls and emails, conference calls with this institutional money that they want gold exposure. They're asking questions now. I don't know if they're starting to buy gold stocks yet or buying a lot of gold exposure, but they're at least asking questions and are starting to come up with a plan to start moving some funds into gold. So I think the gold community had been planning, predicting this for years, but finally it's coming to fruition. It took years longer than people expected, though.
It took longer because we had cryptos, and the young people are much more attracted to cryptos. For them, gold is boring. It doesn't move enough. But as you know, cryptos have now been weakening. And technically, it looks as if Bitcoins and Solana and Ethereum, all these stocks, all these cryptos will go down further. So when cryptos are really declining in earnest, I think asset allocators will reallocate some money, especially into gold and gold shares.
Well, I mean, gold is safer, right? Because isn't Bitcoin's been almost perfectly correlated with the Nasdaq 100, so that would make it more of a risk on a higher risk, high beta asset.
Correct. But young people don't think so much about risk. They think about the reward.
Yeah, I totally agree. I mean, I think it's smart. Mark, I was interviewing you back during the pandemic in 2020 when Bitcoin dropped down to 8,000, and we were talking about how good of a speculation it was back then. So, I mean, like there's a time when risk and reward is lined up to go and buy stuff like Bitcoin as a speculator. So it's just, is it cheap? Is it hated? You have to look at sentiment. I mean, the uranium plays when Cameco got down to like $8, $10 a share, it was cheap and hated back then. So there's a risk and reward for different asset classes, and you're one of the best in the business at this.
I'm not sure, but anyway, here we are.
So last question, Mark. I want to ask you about these types of new technology cycles and causing recessions, difficult adjustments to the economy. We're starting to see artificial intelligence software improvements every month or two now. It seems like we're just starting to see companies announce this all over social media, whether it's customer service jobs, computer programming, graphic designers. Humans are losing their jobs now to artificial intelligence software. Do you think that this adds to the argument that there's going to be a recession? Because it seems like the companies are going to benefit, the publicly traded companies, because they're going to cut costs. but it seems that humans are going to be looking for new jobs and potentially a recession there.
My argument is that the US economy, if the statistics were compiled properly, would have been going into recession in August of last year. But as I pointed out, the way they calculate GDP is a fraud because they don't adjust the price increases sufficiently. So you understand, nominal GDP, say 5%. If you take a personal consumption expenditure index of 6%, you have minus negative growth of 1%. But if you say inflation is 2%, then your real GDP growth is, say, 3%. So the way you calculate inflation, and we would have to define what inflation is, because it's not so simple. But basically, it's an increase in the quantity of money. And if I take the increase in the quantity of money, then the price increases are higher than what the Bureau of Labor Statistics publishes. And two, there are economists who actually use the old method of compiling consumer prices. And by the old method, inflation is something like 10% or more.
Well, it's not just the inflation.
So I think economic growth in a society is when the standards of people go up. And the standard of living of the typical American household has been going down. Nobody can dispute that fact. For 70% of the population in America, the standards of living are going down. But for the 1%, the rich people, the standards of living have been going up.
Oh, yeah, I totally agree. Especially if you were here in the Washington, D.C. metro area or on Wall Street and you got bailouts or you got zero interest rate policy, all that extra capital, all that part of the government budget deficits that were being spent or stolen, the waste, fraud, corruption, and abuse by the federal government in both political parties in Congress. It's just, it led to wealth, but it created just absolutely enormous record wealth disparity.
Correct. The wealth inequality in America is at the highest ever. And I maintain that America is much more corrupt than what people perceive it to be. I think it's highly corrupt. Of the total budget, the budget in America is around $7 trillion, correct?
That's the official number. I think it's larger.
Yes. In a honest society, 5 to 10% is stolen. In a dishonest society, 50% is stolen. In a very dishonest society, such as we find in Africa, maybe 80% is stolen. But in general, in the US, for sure, 10% is stolen. And so if on 700 trillion, you can imagine, 7 trillion, you can imagine $700 billion is stolen.
Yeah, it's just
a lot of money.
It's just mind-boggling, Mark. So I mean, like Doge is trying to cut some of these government contracts and DEI and some of the stuff, but they can't cut fast enough. Plus, you don't see both political parties. What didn't they just raise the debt ceiling by another couple $1 trillion? So like it doesn't really matter which political party's in power. Whether it's Mitch McConnell or Nancy Pelosi, they all want to spend.
Correct. I mean, I think my base case is that under Trump, the deficit will go up and that we will be already in a year in World War III.
I mean, even if those factory jobs come back, Mark, I'm seeing on business television the higher ups in the Trump administration, they're talking about the majority of the factories are going to be run by robots. So yeah, there's going to be investment here. Yeah, they're going to pay higher taxes. Yeah, the companies are going to benefit from robots, but it doesn't seem there's going to be as many human jobs then.
And you need the people to maintain the robots.
I guess those will be higher paying jobs, but not as many. It's not going to be the old days with like 50,000 humans or more at a factory. I think those days are over.
Over, yes. And don't think that China doesn't have any robots because their population is declining. So, of course, they are very advanced stage of moving into a robotic world.
They have Unitree. Have you seen any of the videos? Their Unitree robots, the humanoid ones, can do master level martial arts.
Yes, I've seen some of these videos.
And with the factory worker robots are humanoid, and they look like 70 or 80-year-old men, but they don't get tired and they don't ask for higher wages or mandatory vacation or extra healthcare insurance benefits. So they just keep working 24/7, 365 as long as they're charged.
Yeah.
Well, what a crazy world we live in, Mark. It sounds like most of the asset classes you think are going to be in a correction mode, potentially a bear market. Sounds like you think that the gold market could potentially be one of the few shining stars in the next couple of years with a bull market.
I want to explain something that every investor must understand. Let's say we are in an asset inflationary period. And the average American increases within 5 years his wealth by 50%. And you and I only increase our wealth by 20%. Then you and I have become relatively poor. We are wealthier than before, but in relative terms to the general price level, which went up 50%, we're only up 20%. So relatively speaking, we're poorer. Now, investors, in my view, they always think about appreciating assets. In my view, they should think about going forward a strategy that is geared or has the objective to lose the least. How do I minimize my losses? That is the question. So if the Magnificent Seven dropped by 50%, the Magnificent Seven are already down 37% from the peak. Tesla is down more than 50%. So stocks drop 50%. If you and I only drop 10% or 20%, we have increased our wealth relative to the others. You understand? And in my view, gold, physical gold, will go down less than other investments.
Plus, I mean, the rules could change, Mark. It seems like with these new policies and the trade war retaliation with the tariffs or other types of restrictive anti-free trade policy, we could see rules changes so frequently. So just buying and holding is going to be very difficult for a lot of asset classes.
Correct. Friedrich von Hayek, he expressed the view, the more the government plans, the more difficult it is for the individual to plan.
And we see this in interviews on business TV with the small business owners and the CEOs here in the US talking about Trump tariffs. A lot of them are still confused. They have no idea what's going to happen. They said it was just dumped on them. And the ones who think that it's going to be good for them, they're talking about, oh, well, we're going to get a subsidy. That seems like the only beneficial thing that's like, oh, there's a tariff on foreign goods and we're going to get a subsidy.
It's a crazy, when you think of it, Dodge, they want to cut government expenditure, and yet they talk about more subsidies. Trump is a dangerous interventionist. And what motivates him is unclear because he has very close ties to, say, Netanyahu. Netanyahu is a Zionist and a warmonger. They want war. That's why I'm very careful about Trump.
Yeah, I mean, also like the different policies, how they seem to conflict. A lot of it reminds me, Mark, of reading about the stuff that Herbert Hoover was suggesting in FDR. It just seems like we've kind of unlearned all those painful lessons from the 1920s and 1930s that those policies didn't work.
History is full of people. They know the things that led to catastrophes and they do them again. They should follow the policies of Harding, who didn't do anything. He was corrupt, apparently. But economically speaking, he did the right thing.
Teapot Dome scandal is a drop in the bucket now compared to the white collar crimes that both political parties are getting away with here in DC.
Like,
Well, Mark, I really enjoyed our discussion today. Thank you so much. It sounds like it's going to be very difficult for most people out there that, just buying Bitcoin or buying gold or buying the Magnificent Seven or Nvidia stock, that's not going to work because of all these policy changes that are coming.
I tend to agree. I think it's going to be an environment where returns will be disappointing.
And maybe there'll be a unexpected crash and some good risk and reward distressed asset opportunities. Mark, you are known as one of the top distressed asset investors going in and looking for undervalued assets when the sentiment is hated, the valuations are cheap. I know you've been doing this throughout your entire career, whether it was rental properties in 2008, Bitcoin at $8,000, other commodity stocks in the past. So you have a good track record of finding these cheap and hated distressed assets over time.
Thank you. You give me confidence.
Well, what I'm eyeing now, right, Mark? What I'm eyeing right now, Mark, is just the sentiment right now and the energy plays. Because I'm just seeing the stuff that, like, why would anyone want to own oil stocks? I'm shorting them. I'm just hearing that like nonstop. So that to me is saying like OPEC's going to cut supply. The U.S. oil producers are going to cut supply, cut capex, cut drilling. We're going to have a bottom here in the next probably couple months sooner than people think because the sentiment is just that negative, just that bearish.
I agree. And especially if the US attacks Iran, I think oil prices could go ballistic.
But in the short term, though, I think like the odds are there's going to be less supply. So I think like you're going to start to see very, very soon, like the larger oil producers in the Permian Basin just announced like we're cutting back drilling at $60 a barrel. West Texas Intermediate just makes no sense to maintain the amount of capex and rig count. So we're going to start to see some significant cuts now, I think.
Yes, I tend to agree.
So if my
And
listeners
emerging markets have been hit hard. Hong Kong shares are actually cheap. And Hong Kong is still one of the most wonderful cities in the world. I mean, it's safe. I can't say that German cities or French cities are nowadays particularly safe. Nor is Baltimore and Detroit and Chicago and San Francisco, Los Angeles.
Yeah, there was a lot of bad policies for many, many years there in those cities. Don't want to go into a lot of the details, but there was a lot of mistakes made. Let's just say that was pro-crime.
Yes.
Well, Mark, I want to thank you so much for your time today. If my listeners want to check out the Gloom, Boom, and Doom report, how do they do so? Okay, I'll just put a link to the Gloom, Boom, and Doom report.
Yes, okay. Thank you. Okay, bye-bye.